How's the Lord Mayor? So funny. We need the king to turn up.
All right, we'll get underway. Your microphone, one speaker at a time. Please make sure your mobile phones are turned off. And I'll hand to Councillor Morris to give us an opening karakia, please.
Thank you and good morning everybody here i noi tātou. Tēnā koe i te atua mō te mahi, ko tēnei wā, mō te hui, amene.
I note we've got apologies from how Tapu Baker's online and Hemi Rolliston. Is there any other apologies? Cool. That's yep. No, that's all good. We're all good. And now we move into business. So today we're talking a working draft annual plan for 26-27 and a little bit of OPEX around what we're looking for and starting to shape the plan as we look to next year when we'll be looking at setting that annual plan. So I'll hand over. I believe we've got Christine, Cherie and Tracy. So good morning. Oh, sorry, Susan.
Yep.
Yeah.
Morena, so apologies, Catherine Sharplin can't be here today, so I'm sort of stepping in and helping the team today. So we'll just work through a range of slides. I think probably if we sort of work through the first probably bunch of about 10 or so and then open for questions, I think that will give us a bit of a, we'll pause partway through, I think after Tracy's done her bit, a little bit, and then stop and then work through the additional ones. So the purpose of today's workshop, yep. So as the Mayor has said, this is a working draft. It's not a draft that the staff are presenting with recommendations to proceed. It's the very first coming off the printer's press, if you like, working draft. It's incomplete, but it's enough to give you quite a good feel of sort of the scale of what's coming through and what those impacts of the scale of investment and the levels of revenues that are flowing through are looking like. And that's really what we're trying to do, is sort of have that broader, high level capital revenue envelope conversation and show the direction of travel and start to get some direction from you. So that's the purpose of today. We're going to talk through the key changes in terms of the assumptions, the revenue and expenditure from the previous annual plan and what's different from the LTP. Describe to you how we've gone through the decision-making process and the preparation process to get to an annual plan. I think last time you were relatively new in the role and I think it probably got delivered to you and you probably weren't in a position to actually understand all the makings of what comes into that. So I think we're going to go through a little bit more of that today. We're looking to receive some broad direction from you about where you want to head and what areas you want to have focused on. The intention is that from here, the next steps would be we're bringing that to a 18th of November council meeting. We'll seek some direction at the end of this workshop. You might want to have a further workshop, so you get guidance on that at the end would be appreciated. So we're going to work through the context where we've come from and how we got to where we are, what the key movements are. So just describe those at-scale shifts and what's sitting behind them and why they're occurring. We want to talk through some specific budget movements, and they're summarised there, and to give you a bit of an overview in terms of both subsidies, NZTA subsidies, and what's happening in terms of growth infrastructure investments and risks. So those are the things we want to work through. As I've said, it is a very early working draft. It hasn't had full review. It hasn't had executive review. We haven't gone through and looked at a lot of the detail, but we're certainly feeling that at a high level, this does show you the sort of scale of where things are going. It's not unusual at this sort of level stage of the process that the levels of expenditure and the levels of rates are higher than what you're likely to agree in the annual plan. That's pretty standard about how these processes work, but the question is how much higher and where do you want it to sit? So I think don't be alarmed by the numbers are there. There are a series of choices that you need to make that will determine that. Those are choices to be made politically or directions to be given politically, not for staff to make assumptions on what you might want and build that into the budget. We need the direction from you that they're your decisions. And that's really that next point, is that direction from yourselves and your indications on where you want us to focus, what your capital prioritisation is, what appetite you may or may not have for lower levels of service. Those are all the sorts of things we're seeking some direction from you as we work through. Because it is an early draft, our intention is not to reconcile to the numbers that we're presenting to you today, because that creates a whole series of work on what is very much a working draft. So you won't subsequently see in the next session reconciliations to the numbers that you're seeing today. It is about the scale element that we're talking to you about. The draft budget's been prepared on the principles that you approved and adopted last year, so that was in November last year. You had quite a conversation about those at that time. We've assumed that they roll on through. If you now think they are incomplete or you want to shift, that's also direction we'll be seeking from you. But in the meantime, we've continued to follow through those principles that you've previously advised. Similarly, we've followed and carried through the value for money concept that you've given really clear direction to the organisation, and we've taken that approach, and the staff have got that message in preparing their budgets. And here is the definition that you signed off, and as you're aware, there's a significant program of work underway within council focusing on that value for money. So that's we've still got to reflect some of that into the budgets, but certainly that's underpinning the thinking. So last year in the annual plan, you asked the Chief Executive to make some significant savings, and the organisation went away and did that. So you'll recall that the final annual plan incorporated circa $29 to $30 million of operational savings. There was an organisational reset completed, which saw saw that 108 full-time equivalent positions being removed from the organisation, what we describe as staff establishment levels, so that the staff approved levels of positions was reduced by 108. Those things together, if you take out things like depreciation interest, which are directly related to your capital program, those savings that were embedded into the last annual plan represent 12% of employee and other operating costs against the LTP. So it was quite a significant cut in the organisation. At that time, we committed that they would become base budget and would be ongoing, and that's what's flowed through into the draft budget, or the working draft of the budget that you see here. So we've carried on those, and they've formed the base position. Those savings have not been removed and reinstated. So that's probably a key point that we wanted to talk through, that continues and rolls through into this 26-27 budget.
Okay, so just in terms of the process of the entire annual plan and how it'll run over the next 6 to 8 months, I guess. There's a couple of workshops, including this one this month, the other one's next month, on capital. So that gives you the information that we've used to form this working draft. As Christine said, it's very much a first look. There is a great deal of work to be done by staff in terms of quality assurance and making sure everything lines up, not just in terms of expenditure, but also in terms of how it's funded. This is internal information, and part of that QA process will be a review by executive and direction from executive. There'll be updates that flow through OPEX from capital program prioritisation. And obviously you're undergoing a user fees and charges review at the moment, which will also have some impact. And of course, your own thoughts, preferences, direction will be incorporated as well. Further to that, on the 6th of November, there's the capital workshop, and then on the 18th of November, there is a council meeting which will roll up as much as we can of the last two workshops, and will be a formal report with either recommendations or seeking direction. After that, there'll be more work done through November, and in early December, we'll be able to give you a much better draft, and we'll be able to give you that by activity for your Christmas reading pleasure. In February, March, we'll be looking at issues and options papers. So this is changes to what you might call our business as usual, or what we have already built into the annual plan based on the LTP, so new stuff. And anything falling out of that will be put together for the draft annual plan, which is part of the consultation happening, planned for March, April. So if at any point during that timeline you think there's another workshop required, we'll have to try and fit it in. All right, so the key assumptions that we worked with at the outset were that the LTP increase was 10.4% after growth of 1.5%. What we do know is that growth has slowed considerably since we did the LTP. For the annual plan last year, we used 0.5%, not 1.5%. I haven't had that updated yet, but anecdotally, I'm not sure that there's a great deal of increase in that. The interest rate assumption for new debt is 4.5% versus the LTP 5.1%, so there's some savings in there, but there's some other impacts as well that impact our interest costs. The debt starting point, for instance, is lower than was in the LTP, partly related to opening balances, largely related to opening balances. The CapEx assumption before prioritisation built into these numbers is 540 million. And the other thing that you need to know is when we show you time series of data, and there isn't much in here, but when we show you time series of data by activity, there may be some weird impacts falling out of the reset as budgets have moved between activities to reflect the organisational reset. So just bear that in mind.
That's probably all the context setting. So before we start to move into the actual numbers of what's coming through in this working draft, happy to take any questions on sort of that context.
Councillor Crowther.
Yeah, on the sheet about savings achieved for this financial year, the wording, I know members of the public have sort of said to me, is that true? And I've kind of struggled to answer it in the sense that it's no doubt true, but it depends how you interpret the wording. And to me, the 12% savings in employee and other operating costs against the 2026 LTP is, I mean, first, I guess, just to be very clear, to someone who was pointed this out to me, that it's the 2024 LTP, the 2026 financial year, and the numbers are the numbers. So that's the first thing. The second thing is that the employee costs did go up, they didn't go down. So there's a 2.4% increase. The OPEX went down by 2.6%, but the OpRev went down by just under 2 as well. So I think that's the context, and to try and convey it in an accurate way, to me it would be better to lay it out with another sheet. And I know you've done that previously in terms of a chunk of this, but I've gone back through my notes, I can't find a succinct summary which would back up that 12% saving figure, because it all depends what the baseline is. And if we're using the words LTP as the baseline, I think it's really important to sort of categorise what it is in each of those. So some of that was because the LTP baked in certain costs around employee costs. Some of it is because of we've kind of ignored the fact we've taken on staff for city ops in terms of that reference because it wasn't planned at the time. But in reality, what people out there, our people sort of see is the numbers, and the numbers are the numbers. The cost has gone up for employees. The cost has only dropped a tiny proportion for OPEX compared to the LTP. So I guess I just strongly urge if we could get really tight on using the right wording, and if we're comparing to the LTP, do both. Show the actual numbers and put the percentage reduction against the LTP of, whatever it is, which I'm thinking it's a 2.6% reduction, but then say, however, when you factor in all the blah-de-blah, then it becomes more like a 12% reduction based on those assumptions. So to me, that would be a far more useful starting point. Otherwise, we lose people on the journey right at the start because we sort of can't agree what the starting line is.
Right, Deputy Mayor.
I'm in a very similar vein. But my actuals that I like to anchor against are actuals, not a long-term plan that was never adopted in the current year. So to me, if I hear something that says we've had a 12% savings on employee costs, I'd like to see that as the 25-26 approved budget is 12% lower in employee cost than 24-25 actuals. What we said about long-term plans for year 3 to me isn't all that relevant. So I am now anchoring against 26-27 because we approved that. We didn't approve year 3 of an LTP 24-34 for next year. We've got this year, we've approved a budget and we've got actuals last year, and they're my anchoring figures. So likewise, when we see 108 change positions, I want to see that in an annual plan somewhere that says, an annual report somewhere that says this is how many positions we changed. But we don't get that clarity of numbers. Likewise, even here where we're talking about interest rate assumption for new debt, that suggests that 100% of old debt is already covered and it's longer term than the next year, which probably isn't the case. And this is for 26-27. So it would be interesting, and I've asked that separately, to know what it is this year, because we have definitely had an interest rate cut just recently, and so when we talk about the amount we have to put into each plan for interest, give us a clue as to how we're calculating that. And this is great to have that there, but I'd like that number for what it is this year as well. So I'm needing real clarity of what our start point is, and my start point isn't an LTP that we didn't approve, that's year 3 of it, that nobody really approved because it was just, we often say it's long-term plan, the specific numbers aren't approved, the total is. So I'm going to want far more clarity and transparency around our numbers based on actuals and based on approved annual plan. And I'm going to ask that we're not saying we've already saved 28 million, so we can't save any more. Sorry, Mr. CEO, we still need to look at our costs of running this organisation and keep them coming down. And a really good example is we build this beautiful building because we need all the seats, and then we find we actually probably don't need all the seats. So this is really good to be doing, but I'm going to need much more anchoring as to where the numbers are, but not saying, oh, but that's a lowering of a year 3 LTP that we didn't actually approve.
So the purpose of this first few slides was just a bit of context setting. There are further information coming where we are comparing to actuals and approved budgets for 25-26. What we covered, the issue around the savings, is that when the savings were requested through the 5/26 budget. At that time, the Chief Executive and the Executive team committed to those being ongoing savings and forming part of the base budget for 26/27. The purpose of putting the slide up is reconfirming that that undertaking was given, and it has been reflected in the draft working budget that we're presenting. That was the primary purpose of that slide. There is much more information to come when we do go back and benchmark against those benchmarks that you're talking about. That was really the purpose, to just make that clear, that we haven't walked away from that.
But our people are seeing these slides, not hearing us say we actually want far more detail and far more transparency. So these are public slides, right? They go out, people can see them. We can have people listen to this conversation, but mostly it's. So I just would like going forward some better information so that we actually are able to be transparent about how we are looking at reducing the costs of running Tauranga City Council.
I just had one question in that last one. So I just got to find where it is.
Last slide.
That is the last slide, isn't it?
Oh, sorry, no, well, yes. That's the next one, I think, so I'll leave that one.
Happy for us to move on now to talk about the specific numbers that are flowing through?
Yeah,
Yeah, oh, Kev.
sorry, that's the question there. Interest has increased. So we're just, up here we're saying that our debt's lower and our interest costs are lower. I mean, our interest rates are lower, and then we say interest has increased.
I'll just work my way through this slide, and then I'll get Cherie to come and take the heat on those questions. Okay, so the point of this particular slide is just to reinforce to you the impact of capital. So over the last 3 or 4 years, we have been very much focused on capital delivery. We are now seeing the impacts of that flowing through OPEX, particularly in depreciation and interest as our debt climbs. So depreciation increased 10% year on year, interest 19%, and there's also new operating costs starting to be factored in for some of those new larger assets. That's to the tune of about 1.9 million. So that's year on year. When I say year on year, I mean against the 2026 annual plan that you approved, which is how we normally talk about our annual plans, is in a kind of a year-on-year basis. We often give you LTP just as a comparison for the same year, just for information, but we don't kind of hang our hat on that one, just to hopefully help you. So interest, Cherie.
So the $13 million increase, that's a year-on-year increase. So that 13 million is very high level. That's reflective of the new debt that we have, the new borrowing that we have to do for the capital program and everything in 2027.
Okay. Yeah.
So there's lots of ups and downs in the interest. A lot of the downs are reflecting the lower interest rates on our floating book. There is a bit of a up in terms of the debt that is maturing next year. It's maturing at a weighted average of around 4% because there's a bit of 0% HIF loan in there. And then we have to reissue that at higher rates as well, so there's a bit of an up there. But really high level, that 13 million is the new borrowing that we have to do, as opposed to a $13 million increase on an existing budget.
Okay, no, that makes sense. So that depreciation, that 12 million and the interest effectively is from the 26 capital program that's been delivered, and now we're doing that. So yeah, okay, that makes sense. Thank you.
So this is the graphical representation of what we were just talking about over time. The first few years represent actuals, and you can see quite a steep climb happening there. The red line is related to our PPE balances, our fixed asset balances, if you like. So there is it does show the relationship between having more assets, revalued assets, and the impacts on OPEX. So at the bottom, the first kind of bluish or bluish-greenish colours are all related to assets. That's interest, depreciation, and R&M. So you can see that rising in tandem. So it's not just new stuff, just to hark back to one of my favourite topics. It's not just new stuff that impacts particularly depreciation, it's also the revaluation cycles and activity that we have to undertake. Still talking about capital. The capital program review is underway. At the time of putting together these slides, it was around about 540 million. I understand that it's likely that before it comes to you in early November, it will be down around 500. Given that there is that direct link between between CapEx and OPEX, just for an example, $100 million reduction in capital expenditure would generate interest savings of about 2.1 million in 26-27 and approximately double that in the following years. Depreciation is a lag, but whatever that lag period is, it would be somewhere in the region of 2 to 5 million per annum savings if 100 million of capital was removed. So salaries and wages, we'll have a closer look at that in a bit. But just as general information, there's been a 3.5% uplift for market movement. One of the big impacts that is showing for the salaries and wages number is that the churn assumption that we've used has been pulled right back to reflect what is currently happening in the business. But in pulling that assumption right back, it's effectively added more than 4 million to the cost because churn is a credit. External revenue and expenditure has been uplifted by around about 2.2% for most categories based on the LTP expectations. So potentially that could be a little bit light. And just to let you know that one of the things we talked about through the reset process last year and the whole savings initiative was putting in place processes to improve efficiency. For example, procurement's actually quite a big stream of work. We haven't costed in any savings coming from that. But the work is certainly underway. It's a little bit difficult to kind of pinpoint. But as we get new information, we'll be able to hopefully build some of that in. So as I alluded to earlier, revenue and expenditure changes obviously have a big impact on what we rate. But the other really big impact is how we fund things. So there is some significant impacts in there that bring us up to that 16%. We are now paying down the loans relating to the digital software as a service. There's a $3 million rating impact of that in 26-27, which is just a little bit short of 1%. In the current financial year, part of our funding equation, if you like, was that we had some reserve funds relating to libraries, which we used in 25-26. Those funds are no longer available, so that shows now as an uptick in rates requirement. That's close to another %. We are also paying down or retiring debt from other operating, when I say operating, I mean things like grants for capital assets, third-party grants, as an example, and the city development, which we loan fund, we're starting to pay those down. So that's approximately a 2% impact that doesn't show through revenue and expenditure.
Just reading that slide, I'm sorry, it's not, so budgets as in 26, 27 proposed budget, is that what we're talking about, or budgets in general?
The working draft, yes.
So can we just be a bit clearer, because that could be all budgets? And so what is that telling me? So you're saying that 3 million is going in OPEX?
No, it's not expenditure, it's funding. So we're retiring debt, which needs to be rated for.
So, and what the impact on rates is what, on that top one?
3 million.
Okay, so that, can we just be a bit clearer? So meaning an increase in rates of 3 million in the current year, or in the 26, 27, whatever. What does an uptick mean?
Increase.
Can we just say increase, maybe? And so that's saying that you've got library rates funding, so operating costs in the budget are going up by 3 million.
No. Funding.
So can we just be clearer, please? I'm a flippant accountant, and this is meant to be something that we can, that we understand, and I want to go back and know exactly. Let's be really clear. The line says impacts on rates, including funding. Can we say which is including rate, which is rates and which is funding?
I suppose it's all funding. Rates is funding.
Well, just,
Yeah.
I didn't get it, so it would be great if, your life would be easier if I got it.
I guess what I'm trying to say is that we tend to focus on giving you variances for revenue and expenditure, and yes, certainly those things do drive rates increases, but there's other things that drive rates increases as well, and that's what this slide is about.
Councillor Crowther.
Can I just clarify, Tracy, just the two slides, so this one and the one beforehand. One before is other business as usual adjustments, and then that next one is other impacts. I'm assuming from what you've just said that the 3 million from digital and 3 million to pay off the library debt, that 6 million is not factored into the LTP 10.3 or 4% rates increase, but is the slide which is before that on the business as usual cost adjustments for churn being 4.6 million different, all that stuff, is that factored into the 10.4%, or are you saying that's not really business as usual in terms of the numbers? It's business as usual in terms of it happens all the time, but these particular numbers are not factored into the LTP. Which of those is it?
So when I talk about business as usual, what I mean is that it's not project specific, so it's kind of our base budgets. So in terms of the what I've called other business as usual cost adjustments, so the salaries and wages increase, there would have been a salaries and wages increase built into the LTP. Sorry, I don't know how much off the top of my head, but it probably would have been close to that. The churn assumption is quite different. There was a much higher churn assumption in the LTP. The inflation adjustment was in the LTP. Yep, so that's that slide. The following slide around funding. The repayment of the digital loan was not included. The reserve funding, so the reserve, not having reserve funds available for the libraries in 2027 wasn't part of the LTP because in 2026 in the LTP, reserve funding wasn't used. So, because we... No, there was no change.
Just to be clear, did we whether we all knew it or not, did we use that reserve funding to try and keep the rates increase down in the current year? Is that how it worked? Or how?
No,
I'm not
the
quite
reserve
understanding.
funding was available based on prior rating of the community to support the library. So we used it. It is now no longer available. So it just means that the year-on-year impact is greater. Yeah. Other repayment of operating debt, certainly some of that would have been in the LTP. It kind of depends on how things work through in actuals as to what the scale of that is. Yeah.
Sorry, just in terms of that, the churn, can we, when we do get more detail, can we just have a lot, like all the comparisons of numbers? Because that was something that really stuffed us last year in terms of understanding that 12 million change and something or other. And so, yes, please don't ever go back and say, well, we told you at the workshop it was an extra 4.6 and therefore it's agreed. I'm not comfortable yet with those numbers. I'll need to be thinking about those along with the 108 roles lower and the 12% reduction in expenditure for staff. So it's just please don't say that, yes, we've covered that, because that's not covered yet for me.
Okay, we do have some more information coming on that. Also, can I just point out as well that you've got some more information, well, not more information, but some spreadsheets hopefully coming to you that support the tables and charts in this presentation. And coming up in a few slides, we've got a bit of a breakdown of that salaries cost. And in that supporting information, you'll see every kind of GL line item and the variances. So hopefully that'll help.
Councillor Morris.
Thank you. Just on the churn, is that in reference to the personnel savings that were in the LTP sort of in later years? And the churn has been less than forecast? I'm trying to get a handle on that.
Yes, the churn.
Sorry, because we had a talk about that last year, didn't we? How there was some budgeted personnel savings which were essentially just a paper entry.
So what Tracy's getting at, the churn is basically when somebody resigns and leaves the organisation and the time it's taken to fill it. This is a period of time where you might be paying a staff member a higher duties allowance when they step up into an acting role, but it would be less than the whole, significantly less than the full salary. So then you've got money sitting there until you appoint that's in the budget, but won't be spent. And what we're finding through, one is the economic environment that we're in, that there aren't a lot of job opportunities, and we're seeing that in the number of people that are applying for roles compared to what we used to see a little while ago. And the fact that we've sort of been through a reset, people are, when the turnover rate is slowed, we're seeing that coming through. So there's not going to be as many vacancy periods because less people are leaving the organisation.
Yeah, so it's certainly true that the churn that we assumed in the LTP was a great deal higher than the numbers that we have now. Excuse me. And there is a kind of a companion piece that is yet to be worked through around vacancies, particularly long-standing vacancies. So not really my place to make any promises there, but there's certainly going to be a review of those long-standing vacancies, which will offset some of that reduction in churn. This slide is the one I was alluding to. I thought we may as well talk about it as we're talking about it. This is kind of, like, if you like, a high-level breakdown of the biggest chunks, I guess, of our employee costs. So the first one, salaries and wages, that shows the increase for market movement. There's some other impacts in there which I haven't got to the bottom of, but it's probably related to FTEs at a point in time. The churn, there's your 4.6 million that we were talking about. There's been quite a reduction in capitalised salaries, but we are looking at that, and it may not end up being quite that extreme. One impact in terms of capitalised salaries is just how we are categorising some of the activity in digital in terms of how they support the projects they deliver. We've always, until now, called that capitalised salaries, but actually it should be shown as reduction of contractor costs, so we've kind of moved it in the ledger. So it does make it look worse than it is, if you like, in salaries. The other slight increase in salaries is related to Water's reform, but that is actually recovered through revenue.
Councillor Morris.
Thank you. Sensitive question. You may or may not be able to answer in public, I'm not sure, but just in regard to the market movement of salaries, and I'm just wondering whether a majority of those our employment contracts have a inflationary element within it, within your individual employment agreement, or whether that's based on sort of exec decisions. Yeah.
You're not talking about the budget, you're talking about how we actually apply the budget?
Yeah.
I think that's probably a chief executive question.
Yeah, market movement. Generally, we anchor against whatever the comparable roles are across the sector, and baseline is market movement.
Would that be an employment agreement thing generally, or is that more a decision at exec?
Well, it's an agreed process and policy that we've adopted in consultation with the union or unions, and essentially it's applied on that basis across the organisation.
I think the other comment I'd make, it's by job band. So if we look at the last remuneration round, some jobs received sort of movements of that sort of 3%, some more, and some got very little. Some got zero, or it might have been like a 0.05. So it depends on what the market's doing in that particular. So all jobs are sized, and then we bench that market against the movement against the market, because we know we need to recruit in that market if we need to fill them. Yeah.
So I'd just like to make a statement that I'm not happy that we are proposing a 13%, 16 million increase in employee costs in 26-27. So just for me, that is just something that needs to be worked on, because that to me does not feel like we are looking at how we're managing the costs of our organisation.
Can I? Oh, you.
Yeah.
Yeah, well, that becomes a decision. So certainly when you set the budget, that essentially determines what we can and can't do in terms of remuneration.
Marty, I'm just thinking with the one item there with increase in training to offset reduction in consultants. I mean, do you feel with the reset that's happened, is there scope to maybe bring those numbers down a bit? In other words, have you now got the right people in the right roles, which I know is your sort of goal of that exercise as well, to maybe not need, like, is there any padding, if you like, in the budget now that was maybe there because you didn't know who you'd have in the roles, and now do you see any possibility of reducing that, or do you think that training is going to be essential to kind of bring down that consultants' costs?
Well, one way of bringing down overall costs is by perhaps bringing in-house and employing people that we would otherwise use as have used the service by consultants sometimes some training involved with that. But ultimately, we wouldn't do that unless there was an overall savings to the organisation. So in terms of the reductions that we've made, we made those reductions on the basis that we tried to avoid impact on service delivery, particularly to public, and the services that we provide. And so there were some areas that we didn't impact on at all because of that principle. I think it's probably still too early to understand whether or not that's been achieved. Certainly, I think service within the organisation and across the organisation to support what's happening, I'd say is stretched. So further cuts, in my view, would require a look more broadly across our budgets and our delivery, both to service and in capital.
So based on the conversation so far, just a quick follow-up, based on this approximate staff cost increase, will we see a corresponding reduction in cost of consultants to the council? Is that the aim in general?
Yeah, that's the requirement for us to employ someone within the organisation, which we would otherwise have spent in consultancy costs. So, and that's done on a case-by-case basis.
And in that reduction of that 29 to 30 million last year, or this current year, that was out of staff costs and operating, and the consultant costs were in the operating. So in some areas there was quite significant sums removed out of the consultant budget line, or we didn't add permanent staff, but we retained the staff. And in other areas there was a blend of consultants and staff. In some areas that didn't have big consultancy budgets or very small, that they may have had a staff reduction. So it was a mixture of the two components, looking at what was appropriate for that particular activity area.
So just on the employee costs, can we, when we get this again, have 24, 25 actuals in here? Just because that's, we've been told we've got all these savings, so that would be good as a column. And it would be sensible based on the CE's comment that we also have a line under there to say consultants, so we can actually see that we might be bringing more people in-house, but we're reducing consultants' cost accordingly.
Okay, moving on. So as we've kept stressing, this is very, very much a live work in progress. I know for a fact that the numbers now are slightly different to the ones that you have in front of you. It's very live, it's very, there's a lot of activity going on around the business. I'm looking at this slide now and thinking maybe I shouldn't have put those subheadings in there because some of them could take us down a little bit of a squirrel path. But these are ongoing areas of work. We're reviewing the activity in our digital and communications activities areas. We are looking at allocations and our approach to recovering costs in the organisation. The user fees and charges work is ongoing. The nature and scale of the capital program will obviously impact OPEX and the review of vacant positions that I talked about earlier. There could potentially be some offsetting increases related to the size of loan-funded OPEX. For example, migrating off Ozone as a digital cost. We've seen coming through some additional capital requirement, particularly in relating to landfill that wasn't in the LTP. And there could potentially be other initiatives. So that goes back to the what I was talking about happening in February, March, new stuff coming to you for approval or otherwise. Also, as part of the fees and charges, you may decide, potentially, to put extra rates funding into some of those activities. The other thing, this one is a bit of a squirrel, because it may not impact rates, but it may end up in some kind of weird accounting treatment. So the $29 million expenditure coming up on the Marie Precinct wharfs, because they're not our assets at the time of the work, we're getting some advice on this, but we may be required to treat them as OPEX until such time as it's vested back to us. So it's just one of those weird accounting things that doesn't make much sense, which is why we're getting some advice on that. Right, key financials. Nobody's going to be able to read that on the screen. Hopefully you've got it in front of you. This is the table that we always give you pretty much every time we see you when we talk about the annual plan. The top bit looks at our debt and capital positions with a just super high level operational data towards the bottom. I'm not going to go into that in any detail because you've got your capital workshop coming up in a week or two, and we're going to be looking at operating expenditure a little bit more now. Susan's just handed round a companion piece to what you're seeing on the screen. So the one on the screen and the one in the pack that you were given, the one that's on the agenda, is looking at year on year. So the kind of the working draft figures against the 2025-26 annual plan. It was suggested that some of you may be interested in how that looks against year 3 of the LTP, 26-27. Some of you may not be, but for those of you that are, there is a comparison there in the handout that we've given you. So bearing in mind that, that those variances have come about over a period of probably 2.5 years actually, because our LTP was confirmed very early. Yeah, and obviously that rolls up all of the stuff that we agreed for the annual plan, the current annual plan as well.
Sorry, can I just get you to roll back one slide? I was waving madly, but the net wasn't watching.
Okay. Sure.
Net debt. You talk there in the comments column about borrower notes. Can you explain that to me that doesn't know what that is?
So when we borrow money from our GFA, say next month we need to borrow $50 million, what we get in our bank is only $47.5 million, because there's a 5% borrower note that is held by the LGFA. It's treated as an asset for us, and the LGFA allow us to net that off our debt to revenue ratio. It means that when I'm modelling for borrowing debt, I need to gross up those borrowings so that I have enough cash in the bank for that. It was never particularly material before my time, because borrow notes used to only be, I think, 1.65%, and then they went up to 2.5%, and now they're 5%, and our borrowing is significantly higher as well. So now we need to draw attention to the fact that we're needing to gross up our borrowings for those amounts. In the past, we always under-delivered our capital program, so it kind of just got absorbed within the underspend on capital, so we could just absorb that grossing up. But because it's a significant balance now, I think it's about $50 million in this current financial year, and we can net that off our debt to revenue ratio, it's appropriate for us to start showing that in our net debt calculation, the actual dollar value that we present to you guys as well, so that we can gross the debt up, but then net it off through the borrow notes asset. So it's a convoluted, complicated thing.
So I understand what you're saying. So why did it increase from 1 point whatever to 2 point whatever?
I wasn't around when it had its first increase, but the second increase from 2.5 to 5%, that was an LGFA decision. It's so that they could increase their quality of their capital to retain their credit rating and to make themselves more attractive to the overseas market. It's probably as high level as I can go on that, but I can provide some literature on it from LGFA.
It'd be great if you could just maybe give us something that explains exactly what it is. So essentially, it looks to me like it's a fee that we don't. Is it a fee, or do we actually just not get that money?
Sorry, so the other part of that is that when that $15 million matures in 5 years' time, we receive the borrow note back. So that's why it's an asset for us. We also receive it back with interest. So we receive interest on an annual basis. It's capitalised against the borrow note. So that 2.5 million we would get back in 5 years' time plus interest on it. It's just held somewhere else. Yeah.
Okay. Operating revenue and expenditure. I don't particularly want to just read what's on the slide. I think you've all got it in front of you. I guess, again, this is all pretty high level. This is me sifting through stuff, making sure that it makes sense, trying to figure out what the drivers are. I've made an attempt. It's by no means a perfect science, but I think I've made a reasonably creditable attempt at converting those variances into rates impacts. But I'm happy to take any quite high-level questions on this slide.
Councillor Crowther.
It's not just on the slide, but I'm struggling a little bit with some of the comments around the construction. Like one of them says, construction costs of the last few years now being capitalised. I'm just thinking, isn't that sort of like business as usual? Wasn't that sort of baked in? And it sort of also refers back to the earlier slide with grants for construction of community assets and city development. Now we've got another 6 million there. I'm sort of thinking, are these unusual community assets? Are they unusual construction costs? Or isn't there just like a standard formula? I would have thought all that would be business as usual. And as a little tack-on comment, because we own, in terms of another asset that you mentioned, the Marine Precinct Wharf structure, it clearly says in the agreement that ownership will vest in us. So again, I guess my theme of this question is just, why is there any question around any of this? Like, why isn't it just sort of standard process? Is it that the costs have changed a lot and therefore you've got different numbers, which is perfectly fine? Or is it that there is some unusual mechanisms going on in how you treat different assets in different situations?
Both. So the impact on depreciation, it is due to now we are starting to capitalise all of this delivery, which is impacting depreciation. And yes, that was built in, but some of these assets are quite big, or programs of work are quite big, and in some cases they've been capitalised a year earlier than we had anticipated. And that's a reflection of probably a better process, but it does make it look weird against our LTP certainly. Could you
give an example? I think I'm struggling to try and imagine what something significant is. Is it like, could you name a project that's come in earlier that's done this, or is that the kind of thing
I
it
can.
is?
There was it's not in here, but in last year, I think Cameron Road Stage 1 was capitalised earlier than we had in our plan. There is a great deal of detail that sits behind all of this, and trying to keep it all lined up is a very large job, and we're improving all the time, but you do get anomalies. The Marine Precinct one, as I said, is very much an accounting squirrel. In my head, I'm not going to say I'm the world's best technical accountant, but in my head there's probably a case that it feels more like a prepayment rather than a grant payment, so balance sheet rather than OPEX, but better heads than mine will have to decide that one. Yeah, even if it was OPEX, we would not recommend to rate it.
I know there's complexity around the context, but isn't it quite straightforward? We're building, for whatever reason,
It's
we're
a timing difference. It's a timing difference.
It's our wharf, and it's just treated like every other asset, isn't it?
It's not our wharf until it's vested, and there's a timing difference.
So that's the difference between accounting required and what you have to, how you have to treat it in your annual report and your annual plan. But you could make the choice that you're going to treat it, as you say, from a funding perspective as a council capital asset, and treat it as though it was council's from an accounting perspective, so that when it gets vested, it's already been treated that way. So all this we're pointing out is there's going to be a difference, and you're going to need to make a transparent decision about, do you treat it as operating and rate fund it, or do you treat it as a capital for funding purposes, and therefore you'll have a balanced budget issue that you'd have it as it aligned to recognise that fact, that you make that conscious decision. That's all.
Sure. So you're saying it was in the plan, not as the way that I'm talking about it, not treating it like a road or that's vested or anything else. That you're saying it is actually in the plan.
It is in the plan, but it's in as capital.
Yeah.
So it's the ownership kind of impact at the time of the work.
I can see the logic around that as an example, I think, but the general rule, I think, is just keep it as simple as we can, and if it looks like a cat and acts like a cat, call it a cat.
I couldn't agree more.
And try to make the accounting work that way too.
Thank you for summarising my point. Yeah.
All right.
Okay, shall we move on? Okay, our old friend, the balanced budget. So this is the LGFA measure of the balanced budget, which is essentially that revenue should be greater than expenditure, and that's not just operating revenue, it includes capital subsidies. So as you can see at the moment in this working draft environment, we are reasonably comfortably ahead of that 100% at 102 nearly. Just going back to our previous conversation, however, around the Marine Precinct investment, should you decide to loan fund that, if we come to that position, that would have quite a significant impact on that measure. Okay, allocated costs. This slide is showing the allocated activities and the year-on-year movement. As I alluded to earlier, when we are looking at time series data now, there are some slightly weird impacts. Also, I realised late-ish yesterday that there was a couple of activities missing from this, for which I do apologise. So I was looking at this and thinking, legal, why has that gone up so much? And I know that there was some transfer of work from 2 or 3 other activities to sit within that kind of legal area, but it's not showing on the slide because two of the activities are missing off it. My apologies. And that will be, the complete slide will be on those spreadsheets that are given to you hopefully very shortly, if not already. I guess what this shows, apart from the year-on-year movement, is which allocator activities are, in terms of scale, biggest in scale. So a lot of them are quite small, relatively speaking, in terms of their overall cost to the organisation. Others are quite significant. Just to point out as well that digital, because this is the allocated cost to the rest of the organisation, that includes the funding of, that we were talking about earlier, the 3 million of their debt retirement. That's why there's such a big movement there.
I think this highlights again that it is under review and we really, really, really need to get down to what we are spending in digital. So that this, but the total allocated costs have gone from what to what on at the moment?
If you be with me, I can find that.
Yeah.
You give me just a minute.
It's a big number.
Allocated costs have increased 7 million. I did do something much better. Yep, they've increased 7 million, which is 9% year on year in total. However, bearing in mind that there was that digital debt repayment. If we exclude digital,
So what's the total quantum?
87 million. If we exclude digital, the year on year increase is 3.8%.
But we can't exclude digital. So,
but that is inflated by the debt retirement. That's my point.
Still a big number.
Yeah. Okay, next one. Okay, so we're coming towards the end of the presentation. This chart shows where we are now on the far right, which is before growth, a rates increase of 16.4%. And what it shows is as you step backwards, how much we would be required to save on a rates funded basis to get to lower numbers, and the percentage of direct costs that represents. So if we think about the 25-26 exercise where we saved somewhere around $30 million, you'll see that some of these numbers start looking pretty big.
And sorry, but the 30 million cost reduction was about 50 jobs that were vacant, right? So let's be real about the actual costs that are no longer happening. There's a lot, that it was 108 vacant positions, including vacancies, that were reduced. The 30 million included not having to budget for vacant positions. So, just putting that up there as a trigger, because those are the sort of numbers we are going to try to save without it just being from vacant positions. So we've got to be realistic about what actual costs are reduced, not just taking out vacant positions. And a number of them, I gather, have been vacant for a wee while.
Was there a question though?
Yeah, the question is, if there was a rates cap, right, what is the executive thinking about that they would start doing if there was a rates cap? Because a rates cap, I think, doesn't even get to a 6%. So what I'm saying is that I am not at all comfortable saying, well, we've already saved 30 million, so it will be really tough and we would have to stop picking up rubbish. I'm saying we need to really think about how we operate in this building and how we can do that more efficiently, faster, with more output from maybe fewer number of people.
Yeah, thank you. Yes, we've got that message loud and clear. I think the point is that the personnel budget that was set is essentially the benchmark that we set our sights on to reduce personnel costs for future budgets. And it was on the basis of the FTE allocation that could be delivered or would be required to operate within that personnel cost. That's where we've made the cost savings from. So as far as wider operating costs, it's just an ongoing process. We've got the message loud and clear. If there was a rates cap, we'd have to operate within there, and it's no different than if council set a particular budget, we'd have to operate within that as well. And as long as we make decisions and everyone's fully informed, understand the opportunities and consequences of that, and that's just the environment that we've always operated in.
And I guess it's not at all just about people, but we see projects and we've got somebody saying we've built a great big garden and a new development that actually nobody will walk past, and have we thought about the ongoing maintenance of a garden there? We do see lots of activity that happens that I know we're planting grasses on beside the road, which I go past on my bike. As soon as in 2 years' time, those are going to have to be cut probably 4 times a year so that they're not right across the bike path. Are we thinking it's not at all, let's put it on people, because the people I'm meeting, and I've said this a number of times, the staff I'm meeting that I work with are great, but there's still fat in budgets, Marty. There's still, we're not putting a media release out about the amount we're spending potentially on an upgrade of Hopukiori, Mount Drury, because it's quite a lot of money, and do we actually need it? We probably won't need to have it all. So it's more the culture of, are we thinking all the time, are all the staff thinking, is this garden actually necessary? Do we need all of that planting? Is that, are we doing renewals so that they don't run out right to the end? We'll do it 2 years earlier. Replacing everyone's laptops, where everyone's laptops 3 to 4 years old. It's that sort of culture that I'm getting at, not saying it's about the people. It's about, is the culture good enough that we actually know? I had 3 lights on my street replaced, and apparently it was 4 different contractors that took a whole day to replace 3 lamps, big lights. They apparently can last till 25 years, and these were at 18 years life, but it sort of was convenient when one was being replaced to do the other. So it's that sort of culture change that we need to be starting to see, and I certainly am not seeing that being demonstrated yet.
Councillor Crowther.
Just a question, just make sure I'm understanding the option. So if you take the 6% rates increase option and 37 million needed to be saved, and you've highlighted quite rightly, I think, that depreciation and finance expenses are sort of baked in pretty much. So the movement has to come from employee costs and other OPEX. And so we've got a total of 425 million in the default budget. I just want to make sure I'm understanding this, that the 15% figure indicates that 247 million or thereabouts, let's say $250 million, is probably the rates funded OPEX, like in the categories that I've said, the employee and other OPEX, which works out about 58% of all those expenses are rates funded. Is the implication that the other things, we can't kind of expect to get cuts in any non-rates funded portions of that because they're linked to other stuff, or because I guess what's in my mind is I look at it and say we've got 425 million, we need to get 37 out of 425, but you're saying no, you've only got 247 or thereabouts to play with because that's the rates funded part. But I'm thinking, can you just tease out a little bit what the other, basically 180 odd million, why we can't get some gains from doing that and moving things around?
This slide is about rates. So not all activities are rate funded. Those activities that are not rate funded, by implication, won't help. It won't help if you make savings in those activities. It won't help your rates increase. But absolutely, we'll be looking at efficiencies across the organisation. It is just that in terms of impact on rates, it's a kind of a smaller denominator.
Just to be clear, like, wouldn't they, and I'll use the 247 just because that's the number that comes out when you do the maths, but I'm sure it could be a bit different. But isn't the 247 number a little bit misleading, because some of that other 180 odd million, it'd be something like an activity where you might have 80% user fees funding and 20% from rates. So if we made savings there, it wouldn't be, like we could kind of choose to which part we take it out of. We could move that up to 100% user fees funding, and the public wouldn't get any increase in costs, and we could save that rates and we can move that across. I'm just wondering if we're starting off looking too narrowly at just honing in on areas which are 100% rates funded.
So there's revenue and financing policy implications in all of that, but just to satisfy your numerical question, the difference is what gets you down to that 240 million is Tauriko West expenditure, which we don't rate for. That's very big. Software as a service, sizable. We don't rate for it. Also, some of our grants funding, particularly to BBL, is not directly rate funded within the year. So, renewals grant funding, yeah. So there are, this is what we have people upstairs beavering away, trying to make sense of it, because it's not straightforward.
No, I totally agree, and thank goodness they are, rather than me trying to figure it out. But I guess my point is that some of those issues you talk about are things that I feel are a little bit floating around for us still, like some of the way we fund digital, the BVL stuff. There are some, what I would call, things that people have questioned over our term on council. These are the issues, these are the very issues that we're sort of trying to get our heads around. How can we actually make that as clear, transparent and appropriate, and to Mahe's point, sort of as simple and straightforward as we can in terms of, if it's OPEX, it's OPEX. And I know there are exceptions, and I know Tauriko West is a great example where it's OPEX of a capital nature and all that, but fundamentally I'm not wanting to close off on all that. I'd rather we get a bit more information and see if there's still some possibilities there to change some of that.
So I'm not sure we're clear about what additional you're asking for. So if you can, maybe if elected members have a conversation and be clear about what specific additional information, we're happy to provide it. But yeah, we're both looking at each other and saying we're not sure about, and we don't want to come back with not answering your question. Yeah.
But to your point, Councillor, in order to reduce the rates from whatever they might be hovering at the moment or projected, it needs to be rate funding activity, not necessarily 100%, but a reduction which ultimately strips out whatever rates funds are of the activities that we're delivering at the moment.
Yep, Councillor Correa.
So looking at that slide, you have three options. Is the plan to develop the options further, to look at, the three scenarios? And obviously the one on the left would have a high impact on levels of service, etc. Is that the plan, or are you looking for direction from us whether we want you to do that?
I think I'll answer that. This is really an example indicating what the task would be for us collectively around decision making, around levels of service, and support services. If we were to set targets or trying to set targets, now we came into this meeting and any other previous conversations that we've had with council, certainly in a public arena, have been that there was an undertaking that we would deliver rates increases no greater than those that were indicated in the long-term plan. And so essentially that is a benchmark that from an organisation perspective we believe we can achieve. If it's a desire of council to reduce below that, that becomes a conversation for you, I think, in the first instance, and we would be seeking direction so that we understand what the task is ahead of us.
Further on that, so my direction would be to further develop some scenarios around those three options. I think we do owe it to the community. We hear often people just complaining about affordability, cost of living, etc. And we've got a representative of the public here today, welcome, that would expect that. It's something that we need to look at. What would it mean to have a 6% option? What would it mean to have an 8% option? I'm not saying a huge amount of work, but I think we need to have a good look and give it a fair shot about, hey, is it possible or is it just outside the ballpark? So what would be required of the organisation to come back to us in a workshop or some other forum to discuss what these scenarios could look like? What sort of time frame would be required?
Well,
I'm talking about the reasonably robust, but yeah.
Well, the numbers are there to achieve. We're talking about $37 million from where we currently have in the draft documents, early draft documents. So it would be more significant, obviously, from an organisation perspective than the recent changes we've made. And it would require a serious conversation about levels of service and impact on the community and our capital projects. So that's it in a nutshell. And so we could run some draft scenarios on that, but I think there needs to be further discussion around this table before we do anything.
Yeah, Councillor Morris.
Thank you. So just for clarity around direction, are you seeking direction today on scenarios, or are you envisaging that that'll be the November conversation with some papers? What's the direction you're looking for today?
Well, I think this is an opportunity for councillors to have a conversation. So in the first instance, and I think we're here to support that conversation. Obviously, once you go through the CapEx program, that'll also contribute to, I think, the conversation before we bring back the first draft annual plan documents and budgets on the 9th of December.
So I just want to be very clear, this is prior to putting in any of the organisational resets, etc. This is basically just going straight off the LTP budget, because there's, yeah.
No, the 16.4% includes all of the reset savings that we agreed for the current year. That's part of our base budgeting now.
But then when we talk about employee, we say we don't know what the impact of a reset is.
Where's that?
So employee costs are still under review to confirm results of reset.
Yeah, that's less about scale and more about where everyone sits in the organisation. There's been a great deal of change from a kind of a data perspective, I suppose, I'd say.
What that is, parts of the business have been changed so that they're not sitting in the same groups or clustered together the same way, which means we have to move budgets for salaries from place to place. And that also affects allocations, so how things are allocated. So it's not looking at the total amount reflects the total reset, but it's whether they're sitting in the right activity areas. There's still some further refinement of that as we work through. So
just to be clear, we've got this table we've got with the 26 AP, 27 AP. That 27 AP is adjusted after reset. It's not based on the long-term plan at all. It's based on... Yeah, that one there. So this is all based purely, this is basically taking the 2026 annual plan and
Correct.
okay. Yeah.
I'll have a crack at Marty's guidance thing. I guess the principle I'd look at is when you look at sort of the spectrum of views, I guess both extremes are probably in the room. One of them is Mahe is committed, and I think committed us, to under the LTP number, which you said, Marty. And the other is probably Jan in the back, is I'm sure still wanting a zero. So I guess the approach I'd take is, I'd probably be a bit unpopular with Jan in the back, but probably not to go to zero, but to look at what's seen in our community as what people are calling for. And to sort of measure, to have sort of three options, to take what Auckland Council and others have done, which is to work through three options that capture different predominant views in the community. Whatever we think of, you know, we'll all have different views on it, and some might well be, you know, sticking at the 10% end, and some might be wanting to go further than what the lowest number is. But my concern is 6, 8, 10, there will be a whole bunch of people there, including the government, who say that doesn't capture the range. So therefore, when we present the options, we will be presenting three options, and hopefully they'll flow through to a consultation process, and people can have their say on it. But we will not go with, if you like, you know, CPI plus growth or whatever we want to anchor as the lowest number. And I'm quite sure that the government, if you know, would not be thinking, you know, a 10% rates rise would be acceptable, but more importantly, it's where our community's at and the reality of that. And one of the benefits of having a lower number than 6, so doing something like, you know, whatever the numbers are, I'm not trying to anchor on that, but if it was 3 or 4, and then you go 7 and 10 or something like that, the benefit of having the low number is not just that we could end up, if all went really well, with a lower rates increase, and if we can find a way through, that would be amazing. But the other benefit of doing that is people would see what the cost of it would be. And so when they come to feedback in the annual plan, and you can see what's happened in other councils around the country that have done that, that when it gets to the point where people are really being impacted by that, they will give views on it. And sometimes people do voluntarily ask for a higher rates increase because they don't like what the cost would be. So I don't feel I want to set where the final rates increase should be now, but I do think that those numbers, we've got the top number right. I would like to see the 6 brought down a bit so that we don't lose a big chunk of the people out there who will say, well, you didn't even try to get what I want or what we want. And I'm quite sure if you did a poll on it, you would find there'd be a very significant number. So that's my only thing. It doesn't change much. All it does is it just stretches out a little bit and says, right, that 37 million needs to go up. The 22 can stay the same. You know, stick a midpoint between the two of them and see what happens from there. And we will soon know, as you come back with information, what the options will what the impact will be, and every step of that process I think would be very useful.
Yeah, I think this is less about what we're going out and consulting on. It's actually you as a council determining what it is you want to deliver and by when and for what reason. So fundamentally, I think these numbers are really for, whilst they're in the public, it's not for a public consultation discussion, it's for actually what the needs are of the city and how you want to lead and drive delivery of the program. So we can come back and model what it might look like across those. If there's an option where there is a zero rate increase, we could model that up, perhaps something in the middle and perhaps something more towards what was consulted on and agreed in the long-term plan process. But really this is for you as a governing board to determine actually what it is you want to deliver for the city.
Yeah,
and at what cost.
I just want to be clear, like, I agree with you. All I'm saying is that there is a natural flow on that's been worked really well in some other councils, and I think Auckland was the best example where you actually, in recent times, where I'm not saying you flow out the same information. We will get a different set of info, and they'll be coming in iterative stages, and all that. We'll work through it, and we'll sift out things, remove things, add things, and the public will get something different. But I still think that principle should guide us through how we go out to the public. So they will have some broad summary of here's our preferred option, whatever it is, and this will mean you do get this, you don't get that. If you want to get this other stuff, we will have the background info to know what that cost will be. And I guess I would just say that you mentioned zero. I'm kind of thinking the lower number might be more than zero. Just myself, to the team, that's what I would suggest, that we might be looking more like the CPI number or something as the lowest possible, because those numbers are starting to get pretty big.
I think, yeah, for me, the big opportunity here is in the capital program, and our principles are delivering value for money. Around about a 7% increase in rates is the effect of delivering the capital program. So that's that 12 million plus the 13 million. That's about 7% of our rates. So without any other cost changing, we have a 7% increase in rates that is basically delivered on the back of the capital program. So we can obviously change that, but if we can deliver, that capital program for less than the budget, that will have a massive flow-on effect every year into that OPEX through depreciation and interest, as well as as well as the upfront cost of delivering that. So that I think personally that should be where our real focus is. It's not to say to take the pressure off OPEX, because we want to as well save as much as we can and be as efficient as we can in OPEX. But that to me is our big opportunity. You take 10% out of that. That OPEX, that CapEx program, and you effectively save 1% in rates. So if we can take that 10% savings by doing things more efficiently, delivering the same thing for a better outcome and a lesser cost, that's I think where our real priority needs to continue to make sure we deliver these projects. Because I actually think a 10% saving is an easy target. I think we could be aiming even higher than that. Seeing a number of the projects that have come across our desk, there's lots of opportunities to do things better and in a different way that will deliver a much more value for money outcome for the ratepayer. So that's just my personal steer. I don't disagree about having some options, and let's model some options going forward and saying, here's the impact if you want to pay less rates, these are the things that are probably going to get affected, and see where our community kind of sits with them. I'm quite comfortable with that. I'm not sure we're yet in a position to say those numbers that we want to look at, but I think that's if that's the will of the table, very happy to support that, because I think it's it is giving our community an opportunity to say, this is how far we're prepared to go, or this is the sacrifices. But we've had all this rates capping, we've had reducing rates conversation. There's always a cost to that, and that is the key thing I think we've got to remember. You can't have everything and pay less. It's just not. There is choices that you'll have to make, and I think asking the community what those choices that they're prepared to make is quite a positive thing, because they have an input into where we're going. But that's sort of I guess a steer in what I'm hearing around the table. But Councillor Morris.
Yeah, thank you. In the same vein, I think we need to have a conversation with our community around what they want delivered, or what they can afford to have delivered. So I think building on the savings in the capital program, I think we have to, and I'm certainly up for the conversation with the community about what we don't deliver. And that's within the context of, the Stats New Zealand release the other day around what's made up the 3% inflation figure year to date. And they did call out local authorities, councils, as a contributor to that. That was picked up widely in the media. What wasn't picked up as much was the bigger driver in there was actually electricity and utility costs as well as food. But I think as the 5th largest city in New Zealand, we've got a part to play in terms of the inflationary aspect as well. So we need to look at that. And I think we do really need to have a serious conversation around our community about what we deliver. I know there's the aspiration to deliver, and to deliver affordably and to deliver value for money. That's a separate piece in my view. But I think the quantum and the things that we deliver are something that we have to have a conversation with our community about, because whilst we might have aspirations to deliver certain things, if our community is of a view that it can't afford to pay for it, then we can't do it. And I think we need to be brave enough to have those conversations. It's, I think, easy sometimes to wave the flag and say that we're delivering X, Y, and Z. I think it takes a bit of courage to say, well, actually, we're not going to deliver Z or X, because the economic reality for our people out there is something else. And so I think we've got to be brave enough to have those conversations with our people. It's a bit of a downer. Nobody likes to be a downer, but it's economic reality. Last point I want to make, and it's a bit of a cheeky point, but it's an accurate point. Yes, there's been comments by a particular party in government around rates capping, just one of the three parties, not all of the parties. But I would make the observation that that 11.9% figure is actually the government's figure. That is the government's figure. That is the government-appointed commission's figure. And they had the opportunity to call an end to that before the adoption of the LTP, and they made a conscious, deliberate decision not to. So, if we're going to get into the spin zone and talk about rates capping and whatever the local, the latest focus group is telling our friends down in Wellington, that is your figure. That's not my figure. And I don't think that's the community's figure. I don't think that's an acceptable figure, but that is the government's figure.
Councillor Taylor.
Generally concur with the Mayor and Councillor Morris. My thinking is the capital program is obviously the big numbers. That's where we should be looking. We often to Councillor Morris's point, we often look at the easy stuff to get rid of, the community-based expenditure that we do, and that's the stuff that people talk about as being nice to haves. The big numbers in our capital program are actually roading and waters, and I think we've got to dig a bit deeper this year when we get into this and actually start understanding that a bit better. I don't personally know a lot of the detail. We can talk about a treatment plant or whatever, but it's understanding how we arrive at these budgeted figures, because they are significant, very significant. And then the other thing that I think, as the progress of this process progresses, I think we should be looking at explaining depreciation a little bit better to the public. We've got a massive number now that we're delivering some of this capital program that's now starting to hit our budget every year, and the public need to understand what that means. Why is it adding so much to the rate take, and what do we do with that money then when it comes in? Like the accountants in the room obviously understand what is intended by that, but I think the reality for our public is probably a little bit confused.
Does Councillor Roseboom, did you have a hand up? Yep.
I did, but it's kind of been covered by your comments, Mayor and Councillor Morris. But before I make too much comment on a percentage, I'd like to have a better understanding. As a council, we have spent a lot of money front-loading infrastructure projects, primarily housing at Takitumu and Titumu. When we anticipate when we're going to get a return from development contributions, it's a straight-out best guess based on when we think at the time made the decision, when the houses will start to appear, when the money would come in. Obviously, that isn't happening according to our initial assumptions. What's the cost of funding that front-loaded infrastructure, and who are we allocating it to as who's going to pay for it? Because it's not going to be covered by the development contribution, so where's that cost go?
So interest on development contribution debt is capitalised and added into development contributions. So it goes back into the calculation in which we review every year through the development contributions policy. But we can only recover that from growth still to occur. So say 50% of the 60% of the development is already gone, then you can only recoup the 40% from the growth to come, and the growth that's foregone effectively later on gets transferred from DC funded debt to rate funded debt. So we do a transparent transfer. So if it's relating to Titumu debt, because none of Titumu is rolled out yet, it would be added on, although there's a little complication there because you actually are charging a rate in terms of transport to recover that cost of capital. So, but it does add on to your debt, and it does impact on your debt to revenue ratios. So the slowdown. And the other thing is, because that slowdown's happening, not only do you not get the development contribution, but you're not starting to get the rates coming in every year. So that's why Tracy had up on the slide that we're assuming a 0.5% growth rate, as opposed to sort of 1.5. In some years, we've been sort of at the 2.5 to 3% growth rate, which means there's more revenue, a rating base is increasing. So that makes sense.
On that growth rate, what was the change? I've just forgotten. What was the change that happened at the last minute in the annual plan where the growth rate was different to what was initially talked about? Because I thought it went from 0.5 to 1, but my memory may be wrong on that. But I was thinking it was going to go higher. The talk is that it'll probably go a bit higher this year was what I had thought was being discussed at smart growth.
The final figure that we arrive at when we adopt the annual plan is based on actual data that Jim is seeing in terms of in terms of rating units coming online. Until we get to that point, it changes all the time. So I haven't even asked Jim at this stage. I've just used what we used last year.
No, but I just mean it got through, like I've got an email from Jim around where he didn't mention the final number, but he said he'd been doing it all on 0.5 because that's what it's looking like, and then it changed. But I'm trying to remember whether I don't know if any of my colleagues remember whether it changed to 1, wasn't it? Or, yeah. But it might be good just to make sure. I agree to take a cautious approach to the baseline, but so I'm not too worried about what you use, but just maybe check in about what is the best baseline.
So Jim is looking at what's coming in terms of consented developments, because it's when you strike the rate that is the growth at that time. So it has to be, it has to be a development that is you've seen is going to come in and is going to be in place when you actually strike the rate. So sometimes you might have got a significant consent come, with a number of developments just before you get to strike and that's what happened. So there might have been a significant development that came in, and okay, so that will be included in the rate strike, so we can take account of that. If you don't have one of those and it comes in 3 days later, then it's not included. It's just the reality of how it works. Yeah.
Yep. Sorry.
Can I just make one comment? I think you've been part of these sorts of discussions at the front end before annual plans before, and I think it just speaks to the fact that our funding model is desperately broken, and nobody in Wellington's obviously listening to this, but in our advocacy with Wellington, we can't keep doing this. Councils around New Zealand can't doing this. How we strike rates, where we get them from, not advocating a poll tax, for goodness sake, but the funding mechanism and how we fund our local communities is broken,
25% infrastructure for 10% of revenue.
Yeah, that's right.
So further to developing scenarios, Chief Executive, what's your take on the direction of this council, given what you've heard so far? Is there a desire? Okay, we haven't got the numbers nailed of the 3 scenarios, but is that what you've taken so far? If not, do we need a bit more discussion on that direction?
Typically, we'd either get some direction as to what the expectation was, or we'd come up with a number of scenarios. And to me, it feels like it's a scenario situation where, we will, in my view, come back on at least the 9th with the proposal which actually meets your current expectation. It would be. It was.
Under the long-term plan.
Correct. Yeah. So that's what we will aim to do from here on in. If there needs to be other scenarios included, which I think is a reasonable thing to expect, then we'd probably do some high-level optioneering and assessment of what the impact of that might look like. So it'd be helpful if we had a bit of a steer, but at the very least, Christine, have you got some views?
Yeah, and I think the steer in terms of perhaps the scenarios, but also if you had any particular areas where you thought you'd like to be focusing in terms of levels of service or user fees. You've done quite a lot of work on your user fees. If there's any indication of, are you thinking of some significant changes in that space? Because they're all contributors that add up into the overall equation. So I don't know if you've want to provide any guidance in that space. Otherwise, it will be staff identifying potential options, but we're not clear about the political landscape and whether they might be acceptable or not. So we'll be a bit further off. And if that's okay, that's the understanding we come with. But if you had some ideas of some particular areas you felt were ones that you wanted to make sure were included in there, then we can make sure they come through the scenarios.
I guess and this is, I understand, yes, we can look at capital, that's, 502 million that we are saying, how do we deliver that better? But I'm not going to lose the focus on operating costs, because if we change culture, that's ongoing operating costs that don't happen. So something we will, we can get scenarios, and I think we did last year where we said we won't collect recycling and we won't do this and that and the other thing, but where does we'll look at, so renewals, for example, what's our policy, like in terms of how, we say we absolutely want to look after what we've got, but we also need to make sure we're sweating our assets at the appropriate amount. And my laptop example was something I know from previous life, that when you buy a new laptop, they'll say, it probably needs to be replaced in 3 to 4 years. We sweated ours to 4 to 5 years with no ramification whatsoever. My street lights again, my playground again, I will ask what our policy across the organisation is for resurfacing roads, for changing our lights, for putting in new gardens when we possibly don't need them, for thinking about whether we put in gardens that need agrochemicals or not, or more weeding. And it's that stuff that's not will take away the level of service, but I want to see that we are really thinking about, are we changing? Because we have to change. And if I looked at it at 100, I did a survey of 100 of our 900 submissions for the annual plan, and I put it all in a spreadsheet, every comment they made, every key word, and 38%, I think, talked about the number of people and the cost of actually running this organisation. And it's that stuff that is not negative against people. It's saying, are we as efficient as we can? And from a culture perspective, Māori, that can only come from you. Is that what you're saying? Are we looking at, when we're renewing, what we're actually spending on? How do we make sure, if we have a public toilet, that it is exactly the same as another public toilet with an outside facing on it? Where does that culture change saving? How do we show that?
Well, some might suggest that culture starts in this room. And you've probably, the messages that you've been giving and sessions such as today are viewed by potentially 1,300 staff. And so I can assure you that the message is getting through, and that as part of our program throughout the year, every single person in this organisation is required to make some assessment and contribution or come forward with an idea around what a cost-saving measure might be. So
Councillor Morris.
I'm trying to be helpful with direction. I think it would be good to see the inflation plus 3% option in a paper, what that would look like broadly, as well as the option around a number that is lower than the LTP. So I think that would be my steer. I'd like to see the inflation plus 3 and that number. Yeah. Yeah, well, you can call it that if you like. Yeah. Inflation might be a little bit lower at the end of the year. It might be 2.5.
Yep, Councillor Correa.
Great. I'd like to hear from others that haven't spoken around that scenario option. But in terms of Christine, a bit of direction on, like the user fee discussion, it's not going to achieve a heck of a lot. We talked about dogs for about an hour, our last session, and that's like a $6 a year per ratepayer issue. I mean, goodness gracious. And this afternoon we've got Bay Court. These are small little tweaks that potentially, the Bay Court, the not the professional but the community staff, it could really impact on some of that. We saw the impact on the dogs. People were choosing not to register their dogs or claim that they died, to save like $25 a year impact on that. So user fees, all you're doing is shifting the burden onto from one to another. It's difficult, but we'll go through that process, but it's not going to deliver a big outcome. We need to start seriously looking at some options, and I'd certainly be pleased to hear back whenever that is, around some early development work around those options and what that looked like. The numbers before me here, the 68 and the 10, I'm reasonably comfortable with those options. But yeah, if we can hear from some others that probably haven't spoken on this and provided the direction, that'd be quite helpful. And it's important for us in terms of how we approach this. We saw the Mayor of Auckland get re-elected, with a strong majority, and a lot of that is that he is rated on his financial performance, and that scenario option through that rate increase proposal would have won him votes. And re-election is the ultimate measure of a council and the mayor's performance, you know, and he'll strongly eradicate it. So we could take a lesson from what they did up there.
Councillor Schuler.
Thanks, Mayor. It's been good to hear everyone's comments. I think ultimately has to end up being a balance, because we need to be clear around this table what our vision and our plan and our direction and what we do think is critical and important to deliver for the city, so that our children and the people that are in the community can enjoy it. And then there is also that the current issues that we are facing with the challenges we're receiving around the amount of rate increase. But the numbers are already there. Like, we know that if we're looking at, based on these numbers, so if it's down to 10, it's 22 million we've got to find. If it's down to 6, it's 37 million. So around this table, we need to start to understand what our priorities are, if that's where we're going to go. We've been here a year, 14 months. So I think, you know, we need clarity amongst ourselves. One is what we do want to deliver, and not everything will be delivered in this term for re-election, Councillor Kurak. I mean, some of the things we know that will be in the next, we might be the baton runner now, we might lose the baton, and the next people may take that forward. So we've got Te Manawa Take o Te Papa at the moment. We know it's a huge cost and burden, but it's a vision and a direction of the city that we've inherited and that we now own. We have to accept it. And so I think there's a balance, both sides. I'm really looking forward to this process. We know we've got requests from the community, and sometimes we get demands. Do it better, do it for less. We've given priorities last November to this council about how we want to do business. So we've already done a lot of that. So we've already got our framework to work from. So, and today is a start. It's good that it's out in the public. It's good to hear that we can say, hey, we can deliver a range of things to our community. I think we need to be really clear and articulate as leaders, hey, what you don't get. And we need to know that around this table, because we don't want to be having the argument in just before May last year, whether we put in a Papamau walkway or we do something else. Like, we want to be really clear on what we're trying to deliver for the city. So I think today's been great. There's been some good comment and debate. I'm really looking forward to the next meeting.
Right, thank you. I'm just going to wrap it up. But yeah, thank you everyone for your time. I think the direction going forward is very much around the options, having some different options, but we want to stay below that long-term plan number of 11.9%, and we've got a lot of opportunities around different areas, both from an OPEX and a CAPEX perspective. I think the fact that we're doing a full user fee review, that becomes a part of this, that we want to look at all the options around user fees, and so we can weigh those up and we can consult with our community and decide whether that's a way we want to go, or whether we're happy rates funding everything. But I think hopefully that has given some direction. I think we clearly from this graph here, we're going to have to start looking at some of those savings and how we can achieve them, because we need some savings just to get down to the long-term plan, and I think having options of you can go further, but these are the consequences, I think is a good thing, so that we can make a good decision going forward. So hopefully that's given everyone a little bit of a steer, and we'll keep discussing as to where we're prepared to go to look at some of these savings. So thank you everyone, and we do have other workshops, so I won't close it off fully today, but I'll end that workshop there, and we'll see you back for user fees in half an hour.